Alrighty, welcome back to The Upside with Eli. I'm joined again today with Dylan Reber. Welcome to the show.
Good to be back as always.
Yeah, you're still in your Western wear. We just finished Stampede last week. Did you go to a lot?
I went a couple times, but yeah, Stampede never ends for me, so at least the Western part.
You can take Dylan out of the Stampede, but you can't take the Stampede out of Dylan.
Yeah, exactly.
Nice.
Yeah.
No boots today though.
Yeah, those I needed my feet to have a break.
Right on. Today we are talking all about insurance, which should be an interesting topic. We've had a lot of questions, and we're going to kind of rip through a whole bunch of stuff. I know, you've been writing a lot of insurance lately, kind of going through and doing a lot of work with clients. I'm ready to jump in if you're ready to jump in.
Good to go. Yeah, let's do it.
Cool. So first question we got to go through here is, how much life insurance does the average Canadian actually need, and how do you calculate that?
Yeah, and that's the answer is almost in the question itself. Is like you should calculate it, right? There's basically the general way that we do an insurance needs analysis for life insurance. First things first is determining if your need is permanent or temporary, right? And I think we'll get to that in a bit more detail in a second, but assuming you have a temporary need, usually what we're looking for is income replacement. Basically, the main use of life insurance beyond kind of estate planning is replacing lost income if you pass away, right? So the first thing to look at is, do you have anyone or anything that you need to take care of if you do pass away? If you don't, then your answer is pretty easy up front. It's you don't need any insurance. After that, figuring out exactly how much they would need to have to replace your income, right? So basically what we do is we say, how much would you need invested upfront as a lump sum that could then basically be turned into a retirement portfolio essentially and start, giving income to the remaining family members so that they're in the same financial position as they were before, right? They can make the same bill payments and expenses, keep making the same savings for their future goals. That's something a lot of people forget about when doing a needs analysis. That's the broadly speaking, the methodology that we use. Yeah,
and there's going to be other things too, right? Like, do you want, your spouse, for example, to have the house paid off and just no debt? Or do you want the mortgage, the payment for the mortgage replaced, right? Those are two different ways you can do it. Where some people go, I'd rather have the lump sum of money, have it invested, and we'll just pay off the mortgage over time. People go, I don't want to deal with that hassle. I just want a lump sum up front. You may want to have a number in there to calculate out, like, hey, I want to help my kids pay for their education. I want to help pay for retirement. I want to help pay for, a wedding for my kids. I want to help pay for like all these different things. So you might want some of that stuff built into that calculation.
Exactly.
Right. So there's all these different things to get really personal. And you kind of hit, you already touched on it in terms of, first we figure out, okay, what are all the actual things that are important to you? And you want to, how do we calculate that? And then we can determine, okay, are those things that go away, or are those things that never go away?
Yep. And then to keep building off this, because this is a good question. There's a lot we could talk about, but so like some of the things to look at too is in terms of, okay, how do you figure out how much income you need to replace? It's because it's not necessarily if the person who passed away was making $100,000, you now need to replace $100,000 of that. Tax comes into it, right? We're probably talking about non-registered investments, partially capital gains anyways, and maybe some dividends and stuff. So it's going to be probably more tax efficient than regular income, meaning you don't need to necessarily replace the full gross income. Also, much more obvious is, you still have a surviving spouse or you might, depending on the case, meaning they're probably, but not necessarily, going back and making more income, right? Maybe not right away, but they don't necessarily need all of your income because they're going to be still making some left, right? Usually it's a percentage. Right, that's a common way of doing it. It's like a percentage of family income. You would replace a higher percentage of family income if you wanted to keep the debts, intact and just pay them off over time. Or you could just have a lump sum to pay off the debts, and then you need less income replacement moving forward. You also take into account, survivor benefits like CPP survivor to a certain extent. It's a relatively small benefit, but it's there. And any other kind of sources of income that would continue, right? And also try to think too, I'll just finish on this. One other big mistake people make is that a lot of times they assume that expenses fall by, 50%, right? If one person passes away, It's done. It's not the case. Even for things like obviously the mortgage and debt payments don't change at all. But even grocery bills, right? a lot of times they'll fall maybe by 40 or 30%, right? But it's not usually exactly half. Of
If it's just a couple, if there's kids involved, I mean, you might only drop by like 15, 20%.
Exactly. Yeah.
Right. But yeah, you do have one less mouth to feed. You have one less car to drive, certain things like that. So you want to factor that in. I think another piece in terms of that calculation is figuring out, okay, how long do we need to replace that for? Because if it's like a 5-year period, you can just deplete that capital down. But if it's like a 20+ year period, you might want to pool a capital that it's just self-fulfilling. You have a drawdown rate, but you're never actually drawing and spending the principal, right? So it's kind of be indefinite. So figuring out, okay, how long do you actually need that income replacement for? So if you're 22 years old and you just had a kid, it's a way different scenario than if you're 55 about to go into retirement.
Exactly. Yeah, and I mean, some people, every case is different too, right? These are general the starting points, if you will. But I just did a case actually, for example, where it illustrates how important it is to think about what this would actually entail, right? Because obviously we're trying to quantify the loss of a human life. That's hard to do, right? Yeah. But this client, right, she was of the mind that, yeah, if my husband passed away, I wouldn't go back to work ever. I would pretty much be done. I would just want to spend the rest of my days with my kids and just kind of, living the best I can at that point. So for her, it wasn't even really just replacing income. I was saying, okay, how would, your life would change drastically. So we got, a lot more coverage because she was like, yeah, I'm not going back to work. I would want to be able to just buy a house somewhere else. I wouldn't want to live in the same city and, change my life entirely. Right. So you got to really think about what you're actually trying to accomplish. That's probably really obvious advice, but really
not necessarily for a lot of people, right? Because you'll see that with like one spouse that is really keen on their rental properties, that the couple owns, and the other spouse, like if he's gone, like I'm selling those things. Yeah. I don't want to deal with them. I'm not going to collect the income. I just want to deal with that, right? Or I want to be able to take at least 6 months of a bereavement period, right? So why don't we have another pool of capital in there that just pays out that I know I can just take 6 months off work without having to worry about kind of going back. Like all of those things can have a really big, mental, I guess it can really assist, with things like that when you're going through a really tough period.
Yeah. Yeah. Just be deliberate, right? Don't just, if you're a planner doing this stuff, obviously if you're someone trying to do it yourself, like be deliberate, think through, don't just boil it down to basic numbers because this is a serious thing we're talking about.
Yeah, and maybe what we should do is we should attach a calculator to this podcast or on our website or somewhere that people can go on and see some of the calculators that we use. But yeah, there's a lot of different factors that go into it. A lot of people just say, I just want to cover off my mortgage and that's all I need. It's like I would encourage people to actually think a lot more thoroughly through all the different stuff that they want covered off. Once you've done that, then you can go through and you can make a list of all of the items that you're willing to sell to reduce the amount of life insurance that you need, right? And for most people, that list is going to be quite small, right? You're probably not willing to liquidate your RSPs. You're probably not willing to liquidate your TFSA. You're probably not.
The whole point.
That's kind of the whole point, right? So going through that process, because there are certain things like, yeah, I would sell that car. Yeah, I wouldn't use that cabin anymore, right? I wouldn't, I don't need that, collection of records, whatever it might be, right?
Yeah.
That like, yeah, we would sell those off, and basically you just take one number, subtract the other, and that'll tell you how much life insurance you need.
Yeah, exactly. And before we jump to the next question, because I know this one isn't on the list, but you mentioned it and it spurred my memory. I mean, again, there's never any all one right answer in every case, but pretty much always never get mortgage insurance because of time of claim underwriting. It is such a, in my opinion, predatory, basically a scheme. And that's what mortgage insurance is. And there's other types of insurance. So make sure if you ever see the words time of claim underwriting, at least know what you're getting into, because basically what that is rather than doing the underwriting and looking at your health up front and making a commitment to pay if you pass away, they're saying, we'll insure you, you pay us premiums, but you're not actually really insured until you actually do pass away. And then they'll go through and look at your health and they'll decide at that point in time if they actually wanted to insure you in the first place. And surprise, surprise, they're going to do everything they can to say, no, we were never going to insure you actually.
Yeah, I remember the stats. I mean, I haven't looked at them in probably a decade, but I remember, and 10 years ago isn't that long ago, but I think it was like less than 30% of claims actually got paid out on a postmortem underwriting, right? Where it's, at time of claim. So it's just like, just go get a basic term policy. They're super cheap. Your coverage is in force. and then you're good.
Yeah.
And then there's also other things like, you don't have decreasing, life insurance, like it's the same amount. You're named the beneficiary instead of the mortgage company, or, significant others, named as a beneficiary. There's all these other reasons, but yeah, that's like the no-brainer reason. Don't ever buy mortgage insurance. Just buy a standard policy.
Yeah. And like if premiums are really important to you, like, and just reducing insurance costs as much as possible, if your main goal is, income replacement and paying off the mortgage, both of those things tend to decline. Not always, but they tend to decline with time, right? So like a decreasing insurance policy can still make sense, right? If you get a proportional decrease to your premiums for it. But it's time of claim underwriting, in my opinion, is the biggest issue with those types of policies, because you're not actually really insured.
Sure.
Right.
Makes sense. What is the difference between term and permanent insurance, and when to use either? Yeah.
So here's, the first step of the needs analysis, what type of coverage you get. And, we've been in this industry very long, and we've seen it again and again and again, people getting sold permanent policies who have no business, no need for a permanent policy. It's in the name, right? A term or temporary insurance policy has to do with a temporary insurance need, right? So bringing it back to income replacement, it's a classic example of you're replacing income basically usually until retirement, right? At which point your income, it's a definition of what retirement is you're now living passively off your assets and your pensions and whatever else, right? So you don't have any more income left to replace. That is a temporary need. At some point it's going to end, namely in this case, when you get to retirement. And also
the risk is gone at that point.
Exactly, right? Whereas permanent needs is, no matter when you pass away, whether heaven forbid it's tomorrow or 50, 60, 70, however many decades from now, you need to leave X amount to someone or something when you pass away, right? Or maybe you're using it
not even that. Yeah, I mean, I'm not to correct you, but I would say it's almost not even a need. It's that you want to and it's usually for tax reasons, right? Because it's an efficient way to transfer money between generations, right? And it's for a permanent need like tax liability, like estate equalization, or just because it's a more efficient way to keep money out of the government's hand and give it to people you want it to go to instead.
Yeah, exactly. Like life insurance, permanent life insurance is essentially a long-term tax shelter, right? Whether it's the right one or not depends on, it's case by case. There's pros and cons like everything. But yeah, if you are, the classic, if you're 18 and it's like, now, okay, buy as much insurance as you can and get, whole life or universal life right now at 18 because it's way cheaper than it'll be when you're 65 and all that stuff. It's like, if you're 18, you probably have no idea if you're even going to be able to retire when, which is usually a first step in determining how much is left over after your retirement and available to be used for estate planning. Yeah. So how do you know how much you're going to have excess in 70, 80 years, right, to leave through an insurance policy?
Totally.
And all you're doing if you get, a permanent life insurance policy at that point is just needlessly paying insurance premiums for a policy you don't even need.
Yeah.
And then
it's just a sales pitch.
Yeah. It's don't just buy insurance because it's cheap. That's not a reason to get any insurance, let alone expensive permanent insurance, right? There's a time and a place for everything. That's not it.
Totally.
Yeah.
Makes sense. At what life stage should someone start thinking about life insurance, and does it get more expensive the longer you wait? So you already kind of touched on these. At what life stage should you start? If somebody is reliant on your income, right? If somebody is relying on you, whether it's a child, whether it's a spouse, most people think, well, as soon as I have a mortgage, now I need, insurance. It's like, well, unless you're underwater, right, and there's debts owing and somebody has to assume those debts, like they've co-signed on it, there's still no need for insurance because most people, their house is worth more than the debt on it anyways. So if you passed away, right, it's just, a parent or somebody else is just going to inherit the equity in it. So you still don't need life insurance. It's typically if somebody is reliant on your income or, you've co-signed on a debt or something like that, and they're going to be negatively impacted by you pass away. That's when you start to look at these, these types of things. Now, certain parents will get, and we see it. It's not necessarily something we like really, recommend a lot, but I definitely do see people that the parents are like, okay, kid's 18, let's just get him a $500,000 policy, like a term to 65, because it's actually so cheap. It's like 30 or 50 bucks a month. Who cares? Like just get them that coverage, and then they, then they'll at least have something for, kind of for down the road. Sure. But it's, would I necessarily go out in my way to recommend that? Not necessarily, but I definitely see the rationale and some people have to do things like that.
Yeah, that one's tough for me. maybe this will be our best podcast, Jess, because we're starting to actually disagree on some things, or at least
I wouldn't necessarily recommend it, but I understand from a parent's point of view, sometimes when they do that for kids, they're like, this is such an insignificant amount of money to us. Why don't we just get some insurance in place for them?
For me, I mean, just the way my brain works is optimization. Just even if it's pennies and dollars, those grow to a lot of dollars, hundreds and thousands and potentially millions of dollars over time because of compounding. And so like, the idea of a really common, version of the strategy you described is, get a whole life insurance policy for your kids when they're born, and then you'll build up a cash value that they can access when they're 18. It's like, or just save and invest for them. And then you'll get, I mean, depending obviously on how you're investing or whatever, but assuming, the same exact, for example, fund chosen inside like a universal life policy versus just held as a mutual fund outside, right? So the exact same investment. You'll get a higher rate of return outside because it's not inside of an insurance policy where there's higher fees. Plus, you also will probably be able to find better investments outside of a policy. So, I mean, if your goal is to leave a chunk of change to your kids when they're 18, just invest it. I'll never say, you can never say one size fits all, but you're probably better off just investing it. The one time, in my opinion, where it can make sense to get like a policy for your kids is, with that kind of idea of it'll, grow and then it'll be ready for them when they're 18 is, if like, that there's like some family health issues in your family, or that your kids are probably gonna have health issues for whatever reason it might be, it can make sense to get them their policies when they're kids, right? When the underwriting is usually really simplified and straightforward, and they're not going as deep into health histories and things like that.
Yep.
So at least then they have a basic amount of coverage. If you're expecting that your kids won't be able to go out and get their own coverages when the time comes that they actually need it, I can understand that.
Yeah. And I guess that's where I was coming from, because the case that I was thinking of is that dad completely uninsurable now.
Okay.
And so fortunately he had some term insurance that we, and we were able to convert it to another structure. So we still had some coverage in place, but they didn't want their kids to have to go through that. And so they're like, you know what, we're just going to get a T65 policy. That's just like, whatever. It's like $40 a month. And these guys make a lot of money. So that was zero, that was nothing to them, but it's just to help their kids out. But yeah, I think it's just something that's very, very oversold to kids.
Yeah. That makes more sense then though.
Cool. And then the other part of this question is, does it get more expensive the longer you wait? I don't like that question, because what is expensive? Paying for something you don't need is way more expensive than waiting and then paying for something when you actually need it.
It's a good thought.
So it's kind of like, does it cost more per $1,000 worth of insurance? Sure, but you saved all that money by not buying something unnecessarily that you didn't need. So it's just a common tactic I'll see from like just people who don't do planning work, who just sell insurance. With like, get it as soon as you can when you're young, because it's going to get more expensive as you get older. It's like, well, it's going to go up every X number of years anyways, right? It's usually a way to sell permanent insurance. So I wouldn't, like you hit the nail on the head when you said, I can't remember exactly how you worded it, but buying something now, buying something because it's cheap is not the reason to buy it. Yeah.
And actually, one other thing, part of that too, tacking on to that, I really wish that we taught, at least a basic amount of like financial math, like time value of money math in high school, because it just changes the way you look at the world. And
I learned that in high school.
Nice, sweet. But it's so important. And here's the thing is, if you have the choice of paying lower premiums starting sooner or higher premiums starting way later when you actually start needing it, you very well, in fact, in a lot of cases, the math works out that you are better off pushing it off and saving and investing that money today, because it's going to grow, it's going to compound, right? Not everyone, but most people have heard like, the sooner you invest, the better.
Yeah.
This is basically that, right? Even if you're saving $40, because that's all your policy would cost, when you're super young, that's still $40 a month that you could be plugging away to RSP, TFSA, just investments in general, growing, and really kickstart your wealth building process. You're going to probably be better off down the road if you did that than if you just paid, assumed you might need insurance at some point in the future and then got it because it was cheap today.
Sure. Makes sense. Do employer group life insurance plans provide enough coverage on their own? You want to tackle that one?
Yeah. Long question, but I'll try to keep it shortish.
No.
Yeah. I mean,
generally,
I've seen a couple, like literally 2, maybe 3, my whole time doing this, that are actually solid plans. Most of them are, terrible, right? They're very, very basic plans. And there's quite a few things that go into it, which we'll kind of talk about, I'm sure, throughout the rest of the podcast of, different riders that are helpful, different features. And
Oh, this one is for life insurance.
oh, this is for
group
life insurance.
Yeah, this is group life. So
My apologies.
group life insurance plans.
I was skipping
you're,
ahead.
You're going ahead to disability. So
Life insurance, yeah. I mean, probably not. No, they're usually 1 or 2 times salary, which usually, unless you've got a couple years left to work, that's not going to be enough for income replacement, let alone anything else you want to do. So yeah, you probably need some more insurance on top of that.
yeah, and then the other thing too is that even if for employers who do offer more, like I had a talk with somebody just this last week, she does have 7 times income, in her plan.
Nice.
But if she ever leaves that employer, she doesn't get that anymore, right? So it's kind of like you have all that tied to that one employer. So like, yes, it's really cheap, right? Because it's partially subsidized by your employer. Take it, like take the free coverage, right? Or mostly free coverage, but just supplement that with regular stuff. Like go do a needs analysis, have done by a professional, and just get the coverage. Because again, that like term insurance is so cheap, anyways. Yeah. But yeah, I would say for the most part, yeah, no, it doesn't good enough.
Yeah, and it's good, just to add to that too, and people might be wondering, why would you double cover something? Well, like you said, if you leave and it doesn't come with you, that could be an issue, because what happens if your health changes, in the interim before you leave, right? And then you can't go qualify for your own individual policy when you need to go try to.
Sure.
That's,
And I would assume that most employers are going to have 1 to 2 times salary unless you're self-employed. So if you're the kind of person who's always going to work at an organization or you're in a specific industry and you're going to jump between companies, I think it's a safe bet to assume you're always going to have 1 to 2 times. But again, like the amounts that we're talking are going to be so cheap anyways. It's like just go get a standalone policy, even to top up.
Yeah.
Cool. What is the role of a beneficiary designation, and what mistakes do people make with it?
I think it's probably the biggest mistake is not naming beneficiaries on your policy. That's kind of a
Or
huge
naming
part.
one when you shouldn't.
Yeah. I mean, it's so I guess we'll answer the first part of the question first. Is a beneficiary designation, you're naming who the policy pays out to when the life insured passes away. So that's who receives the money. And a big part, especially for like permanent insurance, but also like for all insurance, right, is the fact that it pays out, it bypasses the will and therefore probate. So any fees associated with that, depending on your province of residence, plus also just the process of going through probate in and of itself, it's really beneficial. No pun intended. So naming beneficiaries is, pretty obvious thing to do. And a lot of people will name like their estate as beneficiaries because they don't know who else to name. That kind of defeats purpose, right? Because now you're just taking something that would otherwise bypass the will and probate and then just putting it right back through those processes.
And I think some of this depends on what province you're in.
That's true.
Because if you're in a province like Alberta or Manitoba where probate is super cheap, it's like, who cares if it goes, through the estate, other than it could get tied up for a period of time. I think where we see a lot of mistakes is people naming their kids as beneficiaries on insurance policies, and especially if they're minor children. Rather than you want it to go to your state. That way you can fund a testamentary trust that you established versus having to be held by the office of the public guardian until that child becomes 18 and it's automatically given to them at 18. Versus if you set up, goes through your will, you have a testamentary trust, and now they get, a little bit at 18, a little bit at 21, a little bit at 25, less rest at 30, right? So it's, I'd say I agree that the biggest mistake could be either naming a beneficiary or not naming a beneficiary, but it is. And the whole benefit of bypassing the estate, bypassing probate is in certain provinces like BC or Ontario where it's percentage of asset. I mean, that can be a huge hit on like a $5 million, policy. Whereas, the bigger hit might be having to go directly to your kid and having them inherit all that the day they turn 18. That could be a way more expensive, thing from a psychological, aspect than it is to pay, some probate fees.
Yeah, that's a good point.
Cool. So we're getting on disability coverage now. What is the difference between short-term and long-term disability?
Yeah, well, also in the name, right? Yeah. There's a lot of complicated financial jargon. That one's pretty simple, right? Short-term disability is meant to cover short-term disabilities, right? Short-term losses of income because you're unable to work because of injury and or illness. Usually 6 months or less, right? Usually very short waiting periods, meaning the benefits start pretty much right away.
Pretty much immediately, yeah.
Right? They're meant to cover, the short disabilities, right? It's pretty simple. Long-term disability obviously is long-term, right? So usually a lot longer waiting periods, right? So longer times before they start paying, meaning you have to be disabled for that time until they even start getting the benefits.
Yep.
So you got to make sure you have something else to cover, like short-term disability or EI or some other source of income, reserve fund, to fill that gap.
Yeah, that's why people have, emergency savings,
Yep.
kind of that financial peace account, whatever you want to call it, put 3 to 6 months of income aside, that type of thing.
Exactly. Yeah. And then it pays out. Well, we'll get into this probably more, but it at least ideally should pay out, until you either are able to go back to work, whenever that is, or until your, retirement age.
Yeah, and short-term disability is generally like 100% of your income paid out for a period. Like you say, it's 17 weeks, a really common amount, generally less than 6 months. And then long-term disability is a percentage, of your income. And usually you can't get more than like 70% of your take-home income. It depends on your income levels and amounts, but ultimately the insurance company doesn't want you better off disabled than you were when you were working. So that's why, it's generally, it's going to, that portion is going to be tax-free, generally speaking, depending on how it's set up, and we can talk about that. But it's a smaller percentage of your income. Short-term disability is 100% of your income, generally still taxable. So there's a couple of different ways, and that's generalizing a little bit, not always. Yeah,
of short-term, like I saw one just yesterday that's like 70%, right?
You're getting ripped off.
Yeah, that's Alberta Health Services, by the way. But I mean, it's usually short-term disability is usually a higher replacement percentage, anyways, than the long-term for sure.
Yeah. How does group disability insurance through an employer differ from an individual policy? And why don't you just explain how disability insurance works for people who don't know?
Okay, start with that. Sure. Yeah. Disability insurance, again, it's kind of along the same lines of temporary life insurance. The main goal, well, in this case, pretty much the entire goal is to replace lost income. There's two main schools of thought in terms of how much income you should replace. There's the full replacement theory, meaning like bring yourself back or as close as possible to the exact same net, meaning after-tax income as you were before. So you can have the exact same lifestyle and expenses and make the exact same savings for your future.
Yep.
I tend to revert to that as a base case, but there's plenty of reasons to divert from it. The other main school of thought is the minimum replacement theory, saying if you became disabled, how much could you reduce your expenses by? How much could you reduce, your planned future goals by, like retirement, so that you can cover a little bit less of your income replacements. Obviously, to minimize premiums is the main reason to do that. But either way, in some shape or form, the whole point of disability insurance is that if you become unable to work because of injury or illness, making sure that you have income coming in.
Yeah,
that's it.
Well stated.
Thank you. There's so many things we could talk about with this, but that's the basics.
Perfect. And then the question here was, how does group disability insurance through an employer differ from like an individual policy that anyone can just go and buy?
Yeah, and so sorry, this is the question I was starting to answer earlier. So for disability insurance, a group policy, they're usually pretty bare bones plans. And when I say that, I mean a lot of them don't really end up paying out, or not for long anyways. Unlike life insurance, where there's obviously exceptions and things like that, but for the most part, if you die, you get the money. With disability, there's a lot more going on. There's how long you have to wait before it starts, how long it'll pay, obviously how much it's going to pay, but also how do they even qualify for disabled in the first place? If you're working part of the time, if you're able to work a little bit, but you're still disabled, is it all or nothing, or do you get part of your benefit? Is your benefit indexed to inflation? There's so many more things to consider with disability insurance. And so what makes most group plans suck is the fact that they are the least favorable in terms of all those things. So most group plans, probably the biggest one, is that they are regular occupation for the first 2 years, and then they go down to what's called any occupation. This is what's called the definition of disability, and it's how they determine in the first place if you're disabled or not, and therefore if you qualify for any benefits. Regular occupation is kind of like, it's a gold standard. It's what most people ideally should have.
Yeah.
Basically, it says if you can't do the duties of your job or anything remotely similar in terms of income and qualifications, then you will get your benefit as long as you're not going back to work in another capacity, right? Any occupation, it's in the name. It's basically if you can do any job, right? So if you were a brain surgeon and now the only thing you can do anymore is go back to work at McDonald's, I mean, you better, because you're probably not getting paid, right? Some any occupation definitions are a bit more favorable where they specify like at least 50% of your former income, but that's still a huge drop to your income, right?
Yeah.
So any occupation is really unfavorable. And so when you have a group disability plan that goes from regular occupation after only 2 years to any occupation, I tend to assume that means your group plan's probably not going to pay after 2 years.
That's right. Yeah.
Right?
Yeah. Most people, you're not going to be able to continue to claim. Obviously, there's always extenuating circumstances, but yeah, if it's a regular OC to any OC, you're probably not claiming after 2 years. Now, fortunately, like the average length of a claim, I think, is around 2 years for people that are on disability for a period longer than 90 days. So again, absolutely better than nothing, and not everybody can afford to just go buy a standalone policy when they're already paying for one of those, but. That's kind of, to answer that question, I think is the main difference between a standalone policy is you can get ONOC, you can get regular OC, a regular OC extension, you can top up to these other things.
Yeah.
Whereas if it's an employer plan, you don't have that flexibility. You're just getting that. And I think every single one I've pretty much ever seen is a regular OC to any OC.
Yeah, exactly. And that's the one of probably the core issue. There's also all the other things like, is the benefit indexed to inflation? I've seen very few group plans that are indexed to inflation, right? Meaning you're going to get $5,000 a month now and 30 years from now if you're still disabled, right? So that's a huge impact.
If you're young.
Yeah, especially. But I mean, especially with inflation, right? It'll be a huge impact.
Fair enough.
Pretty much regardless,
if you're
right?
64, you're not going to be disabled for a year. It's not the end of the world. But if you're going to be disability for like 30 years. And for people who aren't familiar with it, disability generally ends at 65.
Yeah, usually, yeah.
There's certain ones where you can get an extension like up to age 70 and different things like that. But just assume in general, disability goes to 65.
Yeah. And then, also the other one you mentioned, a lot of disabilities last about 2 years. That's on average, right? It's a very long tail to that, meaning there's, the ones that last long can last really long. That's an even bigger issue. There's also a lot of disabilities are partial or residual. In fact, most of them, you're not permanently totally disabled. You can't do any work for the rest of your life. You can work a little bit, right? And the problem is a lot of group plans also don't have partial or residual benefits, meaning it's all or nothing. You're either fully disabled and can't do any work, or you can work a little bit and then you lose all your benefits.
Sure.
That's another huge thing that a lot of group plans lack is that partial or residual benefits. Again, another reason why very few of these policies actually end up paying out for very long.
Yep, makes sense. Is CPP disability benefit enough to live on, and how does it interact with a private policy? So CPP disability, for those who aren't familiar with it, is disability coverage that you get as being a contributor member of CPP. So for everyone who fights me on the internet and says I could just take the amount of money I'm paying into CPP and make more money, yeah, I know you're right. You can do that. But you also get other benefits with your CPP as well. One example is disability coverage. Now, the definitions are pretty strict. On that one. I can't remember it's severe and prolonged, right?
Yeah.
So it has to be a substantial disability in order to qualify for it. So when you talk about restriction, obviously there's certain restrictions on, kind of group plans. Typically, if you get like an individual policy just standalone, you're going to be able to get the best, quality of plan effectively in terms of, highest odds of, kind of claims in our, kind of opinion. CPP disability is very strict, right? Because it has to be severe and prolonged. It's not just like I'm going to be on disability for 6 months, right? It's for a longer term. So don't bank on being able to claim on that for things you could claim on other things for.
Yeah.
And then I actually don't have the numbers completely handy, but it's not very much, right? The maximum amount you're going to be able to collect is definitely not enough to live on.
Yeah, I mean, there's I actually have it right here because I knew this question was going to come up at some point. Basically, as of right now, filming 2026, the maximum amount is $1,741.20. The average amount is $1,234, right? It's composed of that basic monthly amount, which is right now $610.46, plus an additional amount based on how much you've contributed right to the plan. And yeah, again, it's CPP disability it's very, very strict. It's not in any occupation definition, right? It's not any of those, but that is kind of closest to what it is. It's less than half of all claims get approved for CPP disability. So you have to be very severely disabled, meaning you can pretty much not do any job, and it has to be prolonged, right? So it's a very strict requirement. Very, again, less than half of claims actually get approved and paid. And then when it does get paid, it's helpful, right? But it's probably not going to cover all of your income. One other thing to note is that it's also taxable, which I think we'll get into in a second. But again, the whole point is to replace net income.
Yep.
So you have enough money for spending and saving. This is taxable, right? So the amount you get, you got to take tax off of that.
And to be fair, most people who are on CPP disability don't really have any other income in general, so they're not paying a lot of tax. But it is absolutely something that should be noted as well. What is an elimination period, and how should someone choose one?
Yeah, another great question. A lot of good stuff to talk about, but simply put, an elimination period is how long you have to wait and be disabled until your benefit starts, right? So like we said, with short-term disability, that elimination period might be nothing. It might be very short, like a few days or a couple weeks.
Sometimes it's immediate.
Yeah, right.
For short-term disability.
Yeah, and then for long-term disability, common ones are out 90 days, 120 days, 180 days, and you can go out even all the way up to 2 years. Basically, when you're doing a needs analysis, how you determine how much, when, these periods should start. And it's also worth noting that with most disability policies, like individual ones, you can set up different amounts starting at different time periods, right? So you can really customize it to start, when you need different amounts to start. For example, a lot of people in the short term, right, those first kind of 90 days, 6 months, however long it is, right, they'll probably get short-term disability through work. EI will usually fill the rest of that gap. You can also use a reserve fund, right, for any smaller gaps remaining, right? And that'll help you figure out how much you need to actually hold in your reserve fund. Once you get to longer times, 90 days, 120 days, 180 days, your long-term disability plan with work might start if you have one.
Yep.
But that's when EI will start to be phased out, depending on exactly where you live. Your short-term disability benefits will be done by then. And so then there'll be a slight gap that appears. That's what I tend to see happen is around that time period. There's a gap where, your long-term disability plan started paying out, but it's not paying out as much as, EI and short-term was. So then you start a certain amount of your individual policy starting then. And then, assuming you got the typical group plan that goes to any occupation after 2 years, right? You could have, the bulk of your individual plans start at that point in time, which would be usually the highest you can go is 730 days, just before 2 years. But this is just kind of an example to help illustrate, when to choose, right? Look at all your different sources of income, when they start, when they end, and kind of that'll help you pick the elimination period because it, rather than just having it all start day zero, the shorter the elimination period you choose, the higher your premiums will be, all else equal. So, if you can push that off and find other sources of income to help save on premiums, while still making sure you're covered, it's a great way to do it.
Totally. And they have, for people listening, they have specific like group top-up plans. Like, so when you talk to the actual insurance company, they'll have a, premium stuff, knowing that you do have another plan if there are, short-term and long-term that you already qualify for, and you're just trying to top up that, or kind of like what we call a group offset. But for people who are like self-employed or business owners that don't have any types of disability, like 30, 60, 90, 120 are probably the most common elimination periods. I would say 90 is probably the most common because usually the amount you save from 60 to 90 is significant, but the amount you save from 90 to 120 isn't, that significant because usually if you're going to be disabled for a long period of time, it's going to happen. Or I forget the numbers, but it's basically like 90. Like if you're disabled for 90 days, you're probably going to be disabled for 120 days. But if you're disabled for less than 60, there's a lot less of a chance of being disabled for a long period of time. So 90 tends to be kind of that sweet spot. But like you mentioned, it depends on if you're self-employed versus if you have a plan and you're trying to do some kind of offset.
Yeah, and it also depends. Something we haven't really talked about yet is how much you want to self-insure. That's a thing, right? You don't necessarily have to get insurance for every single risk. It just depends. Can you afford to manage it yourself? How much you can afford it? It's kind of like picking a deductible, right? Yeah. So like this is almost like your deductible for disability insurance, right? It's like how long can you go maybe just drawing down your reserve fund or other savings you have until you really need that income to start picking up. To your point, right? I think for a lot of people, it makes sense if you have no other disability plans going on, you're just self-employed or something. 90 days, 120 days usually make the most sense because like you said, the premium, the amount that they start dropping, the further you push that off, it starts becoming less and less. Yeah. It's like less beneficial. Yeah. But if you can push it off from 90 to 120 days, you can get a decent premium savings, and it's an extra month. So make sure you just set that extra amount you would need aside in your reserve fund, and you're good to go.
Yeah. Yeah. No, it makes sense. And for people who are listening who are business owners, if you're doing things like buy-sell funding and things like that, like your buy-sell agreement might have like a 2-year, kind of period where it's not going to trigger your buy-sell, until 2-year periods. That's why you'd have like a 2-year, kind of elimination period. Because like why make that sooner if you don't need it till then? That's typically how a lot of buy-sells are funded.
Yeah, makes sense.
Definition of disability and occupation classes. What are definitions of disability and what are occupation classes?
Nice. Yeah. So we kind of already touched on definition of disability a little bit. We talked about regular occupation and any occupation. So yeah, again, this is how they decide how they qualify for even disabled in the first place. The best one, the most the most favorable, but also by far the most expensive and very few people can actually even get it in the first place is own occupation.
Which is oddly enough, it's actually almost not more expensive because people who qualify for ONOC, their insurance is so much cheaper because their chances of claim are so much less.
Yeah, right.
If you're comparing like a surgeon to a mechanic or like a lot of, dental hygienists can't even get coverage, but like in a career where you're very, very, very high claims rate, it's funny because you're getting infinitely better coverage. You're getting way more coverage, and it's actually cheaper than somebody else.
Yeah, I mean it always depends. I'd say for like the average person, like for a lot of people that we work with, yeah, probably own occupation is the way to go, and makes the most sense. For probably the average person, I think regular occupation is all you really need. But basically, own occupation is if you can't do the duties of your actual job. Even if you are doing another job, you'll still get paid, right? So I always use like the Doctor Strange example. Like if Doctor Strange or some brain surgeon like loses their ability to use their hands and they can't do surgery anymore, but they can still go back to work as a family doctor or something else, right? They can do both. They can still keep getting all their benefits and claim their other income.
Yep.
Regular occupation, almost the same thing. You just can't go back to work, right? In another capacity.
Yeah, you can't double dip, right? There's basically, if you're getting paid from another job, it's only going to cover you up to your previous income. It's not going to, you're not going to get to keep that and have the new income.
Yeah. What does it, have your cake and eat it too? Never made any sense to me. And then again, any occupation is the least favorable one. It's the one where it's probably not going to actually pay out unless you are like totally and permanently disabled. They have things like called presumptive disability, which is like loss of limbs, sight, hearing, that kind of thing. It's at that, in my opinion, it's if you're getting an individual policy and you're just going to get an any occupation definition.
It's better than nothing.
I don't know.
I would agree.
But yeah, it's just at least know what you're getting if that's all you're getting.
And then occupation classes, I would say, it's based on what you actually do. And, it's not necessarily your job title, but the actual duties that you're responsible for on a day-to-day basis. So like, are you doing manual labor? Are you driving, right? How far do you commute to work? Do you just work from home? Right. And all these different things that actually create the classification of risk. A lot of people say, my job title is this. So that should be, they don't care about that. They care about what you actually physically, mentally, like everything that you actually do at work. And then they're going to give you a classification, right? So there's everything from like, C, B, A, 2A, 3A, 4A. And that's kind of how they rate. So like, for example, like a mechanic, like a B is going to be a lot more expensive per, dollar of insurance than, an accountant who sits behind a desk and they make a really good income and they're going to qualify as a 4A, right? Yeah. So that's how they rate what you're going to be charged.
Exactly. Yeah. They're trying to quantify how risky your job is and therefore how likely you are to become disabled and therefore, how expensive your premiums need to be for the coverage. And some interesting things too that are worth noting is, your occupation class isn't necessarily like you're just doomed if you're a mechanic or if you're like a warehouse worker, right? Like I just did one of these for a foreman. Basically, depending on the insurer specifically, but a lot of insurers will have like risk quality upgrader programs, right? Mm-hmm. So some of the other factors that go into, what class you could fall into and therefore, what premiums you're going to pay would be, how much you make. They have, if you make over 60,000 and then over 80,000, over 120,000, you can get, upgrades to your class, which is, obviously nice. How long you've been in your job, right? The longer you've been, you have a better chance of getting upgraded classes. So yeah, even if you are in a higher risk job, it might not be the end of the world. You could still possibly upgrade your occupation class and get lower premiums. If you've been in your job for a long time, if you make good money for a long time, that kind of thing. We'll probably get to it too, but there's also some insurers also offer an upgrade of your occupation class if you get the return of premium rider.
Sure.
Which I still don't understand why that is the case. Maybe you do. But basically, the return of premium rider is basically a feature you can add on to your insurance policy where after X amount of years without claims, you'll get, usually 50% of your premiums back.
The insurance company knows that if you're less, if you're getting money back, you're less likely to claim on, right? The whole anti-selection and those types of things. But yeah, basically what it is that if you're like a natural 2A, you can get upgraded to a 3A, right? And get cheaper pricing. And there's usually a point system by the insurance company that's going to allow you to get those upgrades because they know you're just less likely to claim if you make a higher income, if you're doing the same job for longer, like, because it's just, when we say anti-selection, it's buying insurance with the intent to claim on it.
Yeah.
And so anti-selection just goes down, and so therefore they're willing to reward you for that. So
that's the best explanation I've heard of it. Yeah.
Yeah.
Nice. Because genuinely, I've always known this thing. I've just never really, figured it out why. But yeah, so that's a nice thing is, being able to upgrade your occupation class as much as possible.
Yeah, absolutely. I'm getting the nod that we're running overtime here.
Oh, really?
So we're gonna end it there. That was basically all we had to talk about. Anyways, the next one we can talk about next time is taxable versus non-taxable benefits. But that's getting into a whole other. Oh, I'm sure we can make a whole podcast just on that alone.
Yeah, fair enough.
If you have more questions about life insurance, disability, critical illness, you name it, send us a message. Put it in the chat, and we'll be happy to get to it. But yeah, thanks, Dylan, for joining me.
Thanks for having me.
Always a wealth of knowledge.
Thank you.
Thanks, buddy.